Welcome back to another episode here on the Dividend Doggo Show on YouTube, and I am bringing you into the portfolio right away this morning. We're going to be diving in and looking at the weekly review, seeing what I bought this past week. This was the week, Monday was starting the 6th of August, and we are at the 15th of August. So I'm filming this on a Sunday morning. I've had a busy Friday and busy Saturday, so I'm getting these cranked out as quick as I can to you, but I do want to go over the portfolio jump for the week. Which you can obviously see that it has gone up a fairly significant amount. We are up this week in market gains, $6,129.68. And then we have some earned dividend income that's going to be paid out in the future of $286.49. So that pushed us pretty far back up over the 600,000 mark, and we'll see what the roller coaster market has in store for us going into the third week here of August. So I do want to just go through and show you what the sectors looked like. Utilities, VST was down a little bit here. I will dive in so you can see what that looks like. It looks like the sector as a whole was pretty average to some decent returns from NEE and SO. I believe there was some news for SO that made me wish I had had a few more shares, but I'm blanking on what that was this week. I definitely do want to get around to putting in a little bit more money into some of the other utility plays, specifically in Duke and SO. I think that their dividend growth and value over time is going to be relatively solid. But as far as VST goes, there wasn't really any horrible news or anything like that, just the regular fluctuation. I mean, you can see that it was like less than an actual percent. And we did have some earned dividends. I believe this is the Duke dividend that's coming in, that just rolled into the portfolio. So we will go back out here and we'll look at healthcare was up, AbbVie was doing strong, and Johnson & Johnson both doing fine. Into the consumer pie, you can see pretty much everything was green, but the bulk of the growth here was off of Mo. Mo was coming back up a little bit. It's been fluctuating up and down, kind of a little roller coaster over the past couple months. If I pull it out to the 1 month view, you can see that it's still up about 3%. And I go down to the quarter and we see that it had come down. So it had a little bit of a roller coaster early on in this year, and now it's slowly working its way back up. Home Depot was up, Coca-Cola was up, Pepsi is up solid, Costco is surprisingly up almost 2%, and then TAP had reintroduced their dividend. I believe it was slightly lower than before the pandemic, but they are reintroducing the dividend, which was something I was kind of banking on with the stock. This was just kind of a value play. I mainly bought this off of the back of The Rock and watching Dumb Money on YouTube, because it does make sense. I'm from Texas, and I believe in the drink market there. I'm one of those guys who would go out of his way to buy Shiner Bock, stuff like that. So watching the ranch water videos and the interesting stuff that's going on with this company, the partnership with The Rock, I'm a pretty big wrestling fan, so anything that The Rock is cooking, if I can get my hands in that money pie, I would love to. So if his production company, $7 Productions, if that was something I could invest in, I absolutely would. Just amazing. So then we're going to drop in the Como Pie was up a little bit, mainly off the back of SCHD. I am going to be buying some more SCHD coming up here soon. I do want to build this position up to be a several $100,000 position in the portfolio, just because I want consistent, easy, where to sock the money when you're not having the time to look at things. I'm going to hopefully have some projects coming up to get some extra income coming in for the end of this year. And then I'll be throwing more money into SCHD for sure. Finance was looking pretty good this week too. Bank of OZK was down just slightly, but Bank of America was up 3.69% for the week. That's just phenomenal. That's really, really nice to see that still growing up and climbing. I do want to put some more into this pie and get these evened out a little bit more, especially with Hingham Institution for Savings. I want to add some more to that position. It is a little bit expensive right now, but I only have a couple shares, so I do want to keep growing that. Looking into industrials. Industrials was interesting. LMT is down this week, which leads me to believe that there might be a buying opportunity here for LMT soon. Their numbers are pretty amazing. Like, they've had consistent yield, they've got low PE, they've got good growth on that yield. Their dividend yield is 2.8%, and it's been 20 years of increases. You can see that even Seeking Alpha is kind of shelling out their articles. So LMT is kind of one of those that's on my radar watch list. I only have about 16 shares, and that is a position I can comfortably, easily add to. Their government contracts are backed up. They've got amazing pipeline going forward for the future. 3M is another one that I'm beginning to wish that I had put more money into. You know, everyone was worried about it during the pandemic, but 3M is, you know, still trading underneath a PE of 19.5, has a solid dividend yield just under 3%, and I do believe that it will consistently keep growing that yield, and over time, you know, 10, 20 years from now, I'll probably look back and be like, why did I not see that buying 3M was a decent buying opportunity? One that I definitely wish I had put more money into was Caterpillar. Caterpillar is just doing phenomenally well at an almost 5% market gain just this week. They are just kind of wild. They went on sale briefly, and you know, they're not on sale right now, even with this slight little dip here. They are definitely a position that I want to watch and going forward, and see if I can catch this one again at a better ratio like it was in 2020. If I can get that one at a lower cost position, that is definitely one that I am keeping my eyes out on. Raytheon is another one that I really do want to invest more in, but it is way out of whack for fundamentals right now. I just can't see buying it at these ratios. The PE is 60.7. That's just too high for me. I mainly have this as part of the spinoff. I did sell the other parts of the positions, which I think is, what was it, Carrier and Otis? Something like that. I may be getting that wrong. If I'm wrong, drop me a comment, but I believe they're doing pretty well. The real estate pie brings me to what I've been actually adding to the portfolio for the past week. I did add a few more shares of Vici as this is coming down a little bit overall for the week. I did do a buy on Monday for Vici, and I'm going to show you that right now. You can see that we had some dividend income come in. I did really enjoy that. This money is going to go right back into the portfolio, but we did have one buy in Vici at $530. This actually picked up 17.5 shares of Vici. That brings us to a total income shift after this buy. Prior buy, I had 10.6 shares, and that was earning $3.82 per quarter. So a whopping total of about $15 a year. With this buy into Vici, that brings the income, the total shares up to 28.13 total shares there. And it gives me an income of $10.13 per quarter from Vici. Now their property overall, I'm very interested in it. I love going to Vegas. I went recently, and I did personally see with my own eyes that people are ready to go back to feeling somewhat normal and getting out and vacationing and relaxing. and de-stressing. It's just part of human nature to get rid of the stress load that you've got on you. So I'm kind of bullish on this. I'm kind of with the Joseph Carlson movement on this one. He's been buying the stock like crazy. I'm not as huge a fan of the REITs in traditional brokerage just because of the tax implications. However, this is trading at a very attractive price. I think that anything below the $30 mark is a pretty solid entry point for the stock. It's going to get you an immediate 4.3% return pretty much. And it's solid. I think that it's got a really strong opportunity to grow its FFO, and it's been consistently growing the AFFO and the FFO, which are the things that you want to measure and make sure that those are growing and consistently pushing forward to deal with the dividend payouts and the raises. So this is giving a 9% raise for the dividend for the year, which is absolutely amazing. So that's coming up in the very near future as well. And I've just been adding a little bit more to this position, and I'm going to see if I can probably get this up to maybe $30-$40 in income per quarter and raise that up a little bit further. As you can see, overall, ABR pushed up a little bit. O is coming up a little bit. Store was down slightly, but overall, the REIT pie has been doing pretty good here. It evened out with the market gain, but we've got some good dividends coming in. The $188.77, which will be paid in, I believe, the beginning of September. So that's going to be rolling. I'm probably going to roll that money right back into REITs. I think all the money that I'm going to get from the REITs, I'm going to try to keep in the real estate pie in general. Energy was kind of all over the place a little bit here. It's been up and down. It's been kind of a roller coaster for the past month. You can see if I can pull out to the 1 month view, it's down significantly. Some of these like 9.5%, but I don't carry a lot of money in the oil sector generally at all. I do want a little bit of exposure to it, but I don't want a large amount of money. As you can see, the majority of my money invested is actually in EPD, which is mainly pipelines. And when I bought into EPD, it was, a significant discount. As you can see, I only put in about $9,000, and it's given me a total return of over $5,000 there. And I've only owned EPD. I guess I've owned it for quite a while now. 2 years. I started out. Well, this is the whole energy pie. Let me go in and look at this. Yeah, so September 2020. So we're coming up on 1 year that I'll have owned EPD, and I started with a $10,000 position, and it's just steadily gone up and paid that dividend, and I just got the dividend for it, so I will be reinvesting that. So we're coming up on 1 year in EPD, and the K forms weren't really a big deal. I did work with a CPA on that. It was a very easy issue to deal with. The forms weren't as difficult as I anticipated them being. I kind of went over that with the CPA, and I decided that I would go ahead and hold it at least through the rest of this year for sure. We're going to dive in here to tech. I'm only holding Apple and Microsoft right now, and both of them were up for the 1 week. Apple, I did trim my position in Apple down significantly in this portfolio at the beginning of the year to go into VST. That may have been a mistake, and I'll be very honest with you. When I saw the dip in VST, I really wanted it. You can see that I did have, early on this year, I had a pretty significant portion of Apple, and we have some pretty serious gains I took off the table with Apple. So it's been pretty interesting to see. In February, I did that sale of Apple from about $25,000 down to only having about $400 in Apple in March. So we'll see how that kind of plays out. I know a lot of people would probably think I was crazy with that, but we do hold a lot of Apple in our 401k plans, both My wife's and we have, most, I believe 11% Amazon, and I want to say about 5% in Apple, in each of our 401k plans. So I'm not too concerned about not holding as much Apple in this dividend portfolio. Although, 20 years from now, I'll probably look back and be like, wow, what was I smoking selling Apple? But it had run up quite a bit. So I do want to bring you into the monthly dividend stocks, where we have PDI. PDI is a position that I haven't really added to. I had it in the portfolio. I think that was back from watching Dividend Grinder back in the 2019 or so, when he was still making videos. I believe that's where I picked this stock up on my radar, but this has been a consistent monthly payer. It has come down pretty significantly over the pandemic. Like, I originally put about $5,000 in. It was up at about $8,000. Then it dipped down in the dip pretty significantly, and then it's kind of just been on this very slow recovery, and I've just been holding it the whole time. This does pay an 8% dividend yield. It's one of the highest dividend payers individually, next to EPD, that I have in my entire portfolio. Has an exceptionally high expense ratio. I would not hold a lot of money in this fund. It has very low overall growth, but it does pay that high dividend yield. So you can see that my market gain is actually down on this position, but the earned dividends are up. So it's just slowly putting in up. I want to say this makes about $40 every month that just rolls into the portfolio from PDI. So the other thing I did do some buys into was BST. This is again another monthly payer. This pays just under 4%, has a pretty high expense ratio, but this is mainly a tech play here that is a monthly payer that I actually really liked in 2020, and I really feel like I should have put more money into it. As you can see, the market gain is absolutely wild. The return, money weighted average return for this, I know people get confused when they see this, but it is a money weighted return. There's a mathematical formula, and they think that this is one of the better ways to track your return overall. That includes how long the money has been sitting in the position. And as you put more money into it, that does kind of skewer the way that the return looks. However, when you're looking at how much money is actually in the portfolio versus what the actual gain is, this is a pretty wild return. If I had put more money in this easily would have been a quick double up in the funds over the course of the 2 years that I've had this position open. It started with barely $300, slowly added a little bit of money to it, and then I added a chunk in here, and then it's just kind of taken off and grown. I did add a little bit more money with the shares offering. I did accept that, and I'm curious to see what this company does over the next couple years. I do like having a couple monthly paying stocks that just keep the income rolling in. Stag is another one that's performed overall very well for me. I've had it since the beginning of this portfolio, and I just never put a whole lot of money into it. You can see where the pandemic dropped it down in half, but then it's just climbed all the way back up and surpassed where it was at its peaks in 2020. And it's just continued to grow, and it is trading at a very high PE ratio. This is not one that I would consider putting money into right now, but if this does come down in a dip in the future, I will definitely be keeping Stag on the radar, especially for that monthly income. I believe one of their top customers is Amazon, which is just very interesting and very lucrative for the storage price. For retail and industrial storage. Absolutely phenomenal. So that brings us kind of to a close for how the portfolio is done for the week. It's been absolutely amazing. As you can see the description down here, the goal for this portfolio is to get $80,000 of earned income from the dividends. By the time we go to retire, we're at about 22,000 right now and growing very rapidly. I'm excited to see that snowball roll into this portfolio and just continue. And I do want to thank the people who have been using the referral link. If you use MyPie just for the structure, I would not recommend that you use MyPie and then invest a bunch of money into it, because a lot of these companies have held for 2 years, and they're just, that's why I kind of wanted to go over it in this video, that some of these have very, very high trading ratios for the PE right now, and they're just not value plays at this moment. But if you wanted to use the structure for the pie, you absolutely can copy that from, it'll be in the link in the description down below in the video. And I thank you very much for anyone who has used that. Another referral link did come in for $50 this past week, and I believe this promotion is going to continue this month. They're really trying to ramp up, and this is one of the absolute best promotions I've seen from any of the companies going forward. If they keep this up for another couple months, it's going to be amazing. If you or anyone you know is wanting to get started with a portfolio, I do have my starter recommendation, which is primarily based off of the Como Money style of investing, where it's primarily index investing with SCHD. That link will be down below as well. I believe I called that, what was it, White Fences. Just kind of the dream, being able to just invest easy, relax, and, you know, let that money compound and grow with SCHD. So with that said, you can see I just got logged out of M1 Finance. So I do want to thank everyone for watching the video this week. Doggo is doing pretty good. He had a week off of the chemo meds, and he will be restarting on Monday, tomorrow. So I do want to thank everyone for watching this week's video. I know I ran a little bit long with the video this week, but thank you very much, and I do hope that you will come back and visit the channel again. Thank you for all the likes, the comments, subscriptions. If you do want to ask me any questions down below, I will try to respond as quick as possible. And again, thank you for watching. This has been an amazing journey to get to making $30,000 in dividend income in just 2 years' time. That is absolutely amazing. It takes a lot of hard work to maintain and keep investing, especially with the wild market that we've been on. Have the best week that you can and keep on investing. Drop me what you bought last week down below in the comments.